Hello, everyone. Good afternoon, 2 minutes past noon. Welcome to the New Capital webinar, Year-End Market Review and Planning. My name is Catherine Barr, Director of Communications at New Capital. As always, if you have any questions, you can use the chat feature in the webinar menu. It should be at the bottom of your screen. And we will answer any questions about the content of the webinar in a Q&A session at the end of the presentation. So before I get started, I'm going to make the following regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Thank you for your patience. And now with that, I am going to turn it over to Leonard.
Good afternoon, everybody. I hope you're doing well, and nice to have a pretty good number of you here today. And so maybe we'll test out your interactivity here. So let me just start off by asking, how's everybody doing? You can thumbs up or thumbs down. Just want to know how everyone's doing, just in general. And this will allow you to test your I guess it's not a thumbs up, it's a hand raise. If you're doing well, you know, do your hand raise thing. All right, everybody seems to be doing pretty well. So there we go. Terrific. Nice to be with you here today. And we're going to have two different sections of the presentation today. I'm going to talk about kind of the state of markets with a focus on stock markets. I'll talk a little bit about inflation and a little bit about interest rates, but I'm going to focus mostly on the stock market. And then JC is going to lead us through a discussion of a few year-end things that we might think about doing. There are a couple things I'm probably going to do. For example, I'm looking at making a contribution to my charitable account. Many of you have a charitable account at Fidelity. Hannah and I have a charitable account at Fidelity. And since we're still working age and we're a two-income family and we itemize our taxes, we get a deduction for charitable contributions, and we tend to be charitable to different organizations. And so we're going to go ahead and do that. That's an example of something that JC will be talking about, and I'll chime in as well. Everybody, you can put your hands down now. Go ahead and put your hands down. And let me just ask one question, because your hands, we'll see what your hands do. How many of you are concerned about the level of the stock market? I'll give people a few minutes to answer. You may be, you may not be. I just wanted to sort of take a poll to see what the general consensus. No right answer to this question. Just how many of you who out there is concerned about the level or the price of the stock market? That's all. That's the question. I'll give people a few moments to answer. A few more seconds. All right. So a few of you, maybe 25% or so. Most of you don't seem to be, and that's perfectly fine. So I'll be talking about that. Let me start out here with this slide. This is the S&P 500, and these slides are mostly courtesy of J.P. Morgan and Company, one of our business partners who does a really terrific job compiling this kind of quantitative information. It used to be something that they put out quarterly, and then it was something that they put out monthly. And now it's something that is updated daily. So if you want to update, if you want to get your analytical self-updated. You can do it every single day now. I don't do that, but the benefit of it is that this is data that we're now looking at through the 14th, which is just a couple days ago. So the benefit of them doing these more regular updates is that I don't have to look back to the end of the last quarter, which would have been the end of September. I'm showing you data that is actually pretty much up to the minute almost. And you can see, and I've got my trusty pen here again. Everybody will remember, however, that sometimes it takes me a little bit to sort of activate the drawing tool. I'm going to do that. Everybody can kind of see. Look at it and put it in a different color, huh? How do I change the color? Maybe that. Okay. There we go. Look at that. Look at the steep climb that this market has made since March 23rd of 2020 during the full-on, what would you call it, really panic of brought on by the pandemic. And at that time, the S&P 500 was trading at 2237, and we are now at 4634. At the time in March of 2020, 13.3 times earnings on the index, trading multiple of earnings 21.1 now. And I think you can see that this is this has been a very, very the steepest climb. This is charts going back to 1996, and you can see the sequence of bull markets. This was a pretty long one, right here, that continued. Look at the length of that bull market that ended with the pandemic drop, right, from 2008 all the way to 2020, and then, but look how short the down was versus this bear market here and this bear market here. This was this was straight down and then immediately straight up. And now, when this was a time when people were incredibly fearful, now this is a time when people are incredibly greedy, really, right? I mean, that's Warren Buffett talks about the two opposite sides of the coin, fear and greed. And I don't know that we've ever seen such a rapid turnaround in stock market history than this, going from this incredible fear so quickly to this really, really strong greed impulse that's going on. And let's talk about some of the metrics that are associated with the market over different periods. So this would have been the tech bubble that occurred. And at that time, the index was trading at 25 times earnings. We have not seen a market peak that, including now, that reached that level of 25 times earnings. Even today, 21 times earnings, still not near that really, really high peak, which occurred right here, right? That would have been the peak of the tech bubble. The dividend yield, roughly the same at that period, but look at the difference here in the US Treasury. If you did not like this, if you said that market's just too rich for me, 25.2 times earnings, you could say, you know, I think I'm just gonna take some risk off the table, and I'm gonna go into the risk-free 6.2% 10-year Treasury bond, and you would have made a pretty decent living, right, on the 10-year Treasury bond. No longer. Look at that, 1.4% on the 10-year Treasury bond means that there's not a really appetizing place to go. There is an exception to that we're going to tell you about in the planning section. Unfortunately, it is very limited in the amount that you can buy. JC and I are going to talk about it though. It'll take up some of your capital, but there is a limitation on how much of it you can buy. Okay, so I think you guys are getting the picture that we're in right. Wow, it's a lot of red on that screen, isn't there? All right, how do I erase? Let's see. Oh boy, clear. That's it. Clear all drawings. All right, next slide. I'm going to go back to this. All right, this is the forward PE ratio. It's kind of looking at a bit of the same information, but this is showing you the chart not based on the level of the index, but based on the PE ratio. And these bands right here, these dotted band. Oh, what did I do? Whoops. These dotted bands. Something happened. Let me clear that again. Sorry, everybody. Something freaked out there. Drawing. Okay. These bands. This one and this one and this one. These are your over and undervaluation bands by standard deviation. So the 25-year average PE ratio dating back to 1996, and this is forward. This is looking forward. This is not looking at backwards earnings. This is looking at expected earnings for the S&P 500 is 16.82. That's the 25-year average. And you see that we've had periods of very great undervaluation, low valuation rather, in 2008 with the financial crisis. And then we also had it as well right here. This would have been, I think, the European financial currency crisis. And we've had periods of very high valuations. That is the tech bubble that I've talked about quite a bit. But you can see that we have not had another period where we are over one standard deviation, right? This is one standard deviation line, right? And you can assume that this was just about two standard deviations. You can see that on the chart, right? This hit almost two standard deviations, meaning a rare occurrence of that kind of high valuation. That's what standard deviations are measuring, is the frequency of the occurrence. So this would have been a very rare in market history occurrence of that kind of high valuation. And you can see that these days, right, at 21.06, we're right here. There's that dot right there. That's kind of where we currently are, a little bit over one standard deviation, but we are a long way from that kind of undervaluation. And so this is what causes market professionals to say market is, at the very least, not cheap. The S&P 500 is what we're talking about here. That is the market that's being reflected, the market index that's being reflected in this graph, right? And then here are a whole bunch of other measures. And you can see that in general, the standard deviation over undervalued, all of these numbers here are 1.8, 1.8, 1.5, 2.1, right? They're all in the high ones, right? Standard deviations. We're approaching two standard deviations on the valuation versus average. And it doesn't matter whether you're looking at the price to earnings ratio, or the so-called CAPE ratio, or the dividend yield, or the price to book, or the price to cash flow, right? This is the earnings yield spread. So this is the earnings yield on the S&P 500 minus triple B corporate bond yield. Okay, so that's measuring a stock earning versus a corporate bond yield, and where that is at, and that spread is at 1.5% versus a regular average of 0.16. All right, clear that and move on to the next. Did I do it? No, I didn't. Okay. And this chart, and again, you guys have seen these charts a number of times. A lot of times when I do the presentations, I use these charts. I'm not trying to bore you by using the charts again. I'm returning to these charts because you've now seen them, and the more you see them, the more you get used to knowing how to read them. And that's why I use them repeatedly, because the more we do this together and the more I show you these charts, the next time you'll be even better at understanding what I'm showing. I don't have to explain them as much. So that's why I use these charts. Now, this chart, sometimes I give it to you. What this is showing is that as the PE, why does it do that? Sorry, everybody. Something's going on there. Let me try again. As the PE ratio goes higher, and this is looking at 1-year returns and 5-year returns, but they're similar charts. As the PE ratio goes higher, this axis right here and here, these axes are the returns. And what it's showing is that there is a negative correlation. You can see that this trend line right here, right? There is a negative correlation, and all these dots are single year observations. And so this is a dot plot, right? This is a plot on 2 axes of all of the individual years. And what it's showing is that, as you know, and this is just common sense, as the valuation goes up, the subsequent 5-year annual returns go down. The more highly valued things are, the lower returns go. And where we are right now is that subsequent 5-year returns are looking very paltry. I've made this point repeatedly to you all, including discussing during our conference back in October, discussing the predictions that are being made by the likes of Vanguard and BlackRock. And this is where they get these types of predictions. This is the data. This is actual real world data of what subsequent returns looked like when certain valuation levels were reached. So you don't have to memorize this data, but what you need to internalize is that when valuations, get higher, 21.1 times earnings, that scientifically, if you will, returns go down in the future. Now, there is some good news, and the good news is that earnings, this is the S&P 500 earnings per share, are predicted to be high, right? Here's the pandemic when everybody quit coming out of their homes and quit buying lots of stuff, except for like Peloton bicycles, right? And I don't know, takeout. And now we see that here, look at the expected earnings. And so here are the earnings on the S&P 500, going back to 1988. And then, I mean, look, this is where the predictions are. And so, the profitability of companies is robust. So everybody needs to think about that and factor that in. The profitability is robust. And over on the right-hand side on this chart, this is reflected in the fact that the return this year of the S&P 500 is 23.4% year to date. Very, very strong year for the stock market. And for all intents and purposes, it's been pretty steady. We've had periods, especially a couple months ago, when the market fell off the pace, but in general, we've had a pretty steady year. And what has driven the increase has been earnings growth. You can see right there, 30.5% is the contributor of earnings growth. The multiple has actually contracted on the market, meaning the current multiple on the stock market is actually 7% less than it was at the beginning of the year. And you can see that right here, that the multiple has gone down, but the earnings have gone up. So it's very important that everybody understand that there is a strong earnings backdrop that underlies the valuations in the market right now. And you know, if somehow the world goes into earnings nirvana, you know, then there's nothing to say that it can't continue with a high valuation. Now, if earnings fell off, you know, you can imagine what the market's going to do. And so it may be that the market is betting that, you know, there's further to go in profitability, and we've hit some sort of super hypercharged growth. We are seeing strong growth in the general economy to the extent that we are seeing 4 and 5% real GDP growth. That's after inflation. I know we've got inflation. I'm going to talk about inflation, but we are seeing real GDP growth after inflation, 4 to 5%. That's a huge number. Remember, we were trying to get to 4% before inflation, and we're seeing 4% after inflation out. So the real growth environment for the general economy is very strong, and that's translating into profitability for companies. Okay, the valuations are not unfounded, given the low interest rate environment that we're in and the strong growth that we're seeing both in the general economy and among companies. What was I going to talk about here? Oh, I know. So really, it's sort of this slide is echoing what we were just saying. We're seeing right now, this was in 2020. You guys, I don't know why it's doing that. It's like I'm getting hit by a lightning bolt from my computer. I guess the screen is wiggling a little. You know, here in 2020, right, profitability fell off. And what this is showing is that there are 3 different components of earnings per share growth: margins, revenue growth, sales growth, and share count, right? Companies could issue or bring in shares. And if they bring in shares, then that would increase earnings per share through share buybacks. And what you can see that's going on here in 2021 is very, very powerful margin expansion. That means that companies, even though we're seeing inflation, companies have been increasing prices or seeing their costs go down. I don't think we're seeing costs go down. What we're seeing is that companies are increasing prices, and more than increasing prices. They're passing on high price increases on to customers. And I've seen that when I go into Home Depot, something I got to get, and the thing is crazy, you know, crazy expensive, but I got to get it, and they have it, and I buy it. It's just that's it. I buy it, you know. Or you go into the restaurant, and you know the pizza's now. You tell me, what's a pizza now? You know, $29.99. Okay, now some of that is inflation. Some of that the pizza worker's making more now, and the cost of bread is now. But it, you know, it hasn't gone from a $14.99 pizza to a $29.99 pizza, and it's all going and getting passed through to the flour maker and the pizza maker and the pizza worker. The companies themselves are seeing margin expansion. In other words, companies are taking advantage of this inflationary environment to raise prices very meaningfully and add to their margins. So you guys as shareholders are benefiting from that. This chart is showing the relative valuations, valuations between growth stocks and value stocks. And we've talked for a long time about how value stocks are far more, man, sorry, everybody. How value stocks are more attractively, I'm going to ignore that, attractively priced than growth stocks. When this chart is high in the upper reaches, that means growth is cheap and value is expensive. And when this chart is in this lower quadrant here, then value is cheap and growth is expensive. And this is where we're at. So you can see value is cheap, growth is expensive. And that has been the trend really since this point in 2015, 2016. And so why this is important is that we can say that while the market in general is expensive, it isn't that the whole market is expensive. There are places, very substantial parts of the market, that are not as expensive as other parts of the market. And what the chart on the right shows is that there are an earnings correlation to real GDP. And I told you a second ago that real GDP, that is gross domestic product growth, net of inflation, after inflation, that there are sectors that do very well in those types of environments where real GDP growth is strong, and tops among those are industrials. Look at the correlation. So the industrials sector is a sector that isn't that expensive and does very well when we see high real GDP growth. Financials is another area, materials, energy. You see that there's a whole series, real estate, there's a whole series of industries that are value industries, not growth industries, right? These are growth industries. So, leave those aside where they're more expensive, but there's a whole area here where these valuations might be more attractive. All right. This is looking at the top 10 stocks in the S&P 500. I've talked about that before and how we have to be careful about chasing the top 10 stocks, because very often after a stock enters the top 10, its performance for the subsequent 5 to 10 year period is poor. That has been the historical record, and I showed a really dramatic chart of that at our conference. I didn't put it in here today. If you want that chart, shoot me an email and I'll send it to you. A very interesting chart. And so basically the gist of that chart is be really careful about buying the biggest, hottest stocks, because they tend to suffer. And we can see back in the tech bubble, I'm going to ignore that. You ignore it too, that lightning bolt. Some sort of friction or something going on with my pen is zapping it with static electricity, the screen. So that's what I'm assuming is going on. So just ignore the friction electricity. But if you look back here in 2000, you can see that the top 10 stocks at that time, the top 10, the top 10 stocks were trading, up around 40 times earnings, right? The top 10. And now the top 10 stocks again are trading up around 35 or so times earnings, 32.5 times earnings. Here, that's the number, 32.5. The remaining stocks are trading at 19 times earnings now. So the top 10 stocks are expensive and contributing to a lot of the valuation. Now, there is a difference. This is a really interesting thing that we're going to see in the chart over on the right. There's a difference between what was going on in 2000 with the top 10 stocks, which at that time would have been, Cisco Systems and Enron and Dell, for example. I think Microsoft was up there. And the difference is, take a look at the earnings contribution, more lightning. Take a look at the earnings contribution of the top 10 in the S&P 500. In 2000 or so, right, you can see right here that even though those stocks were valued so highly, they were only making a roughly 16% contribution to the earnings of the S&P 500. That is different than right now, where the top 10 stocks as of December 14th are contributing 26% of the earnings of the S&P 500. 1/4 of the earnings of the S&P 500 are coming from the current top 10 stocks versus back in 2000 when the top 10 stocks were accounting for just about almost half, 16%. And so the point is this: the current top 10 stocks are not flashes in the pan the way that they might have been back in 2000. These are not just highly valued behemoths, but very profitable behemoths. We're talking about the likes of Apple and Amazon and Microsoft, right? There's real earnings there, and they're being valued on them. So that's another piece of, I guess I would call it, good news, that that takes the valuation of stocks right now, puts it in a little bit different context, so that when people come to you at the cocktail party and say, hey, it's the exact same thing as we were looking at in the tech bubble of 2000, exact same thing. Hey, drink up, cheers, here's to the new year. It's exact same thing. You can say, well, there are a lot of similarities. However, the top 10 stocks now, much more profitable, substantially profitable than those stocks in the top 10 were back in 2000. Hope that's helpful discussion there. Sorry about the lightning bolts. I don't know how to stop it. And this shows you a bit of the same picture that I've been trying to describe. This is the dispersion. Let me see if I can go slow here and maybe not get a lightning bolt. No, a little bit of a lightning bolt. Dispersion. And you can see that there are times, such as during the tech bubble, when there were highly valued stocks and lowly valued stocks, right? There was a wide dispersion. You could have a wide pick if you said, well, I want to own just less expensive stocks. There was a pretty good amount that you could choose from. If you said, it's if somebody came to you then and said, well, it's all expensive, you could say, well, no, it's not. Here's a bunch of stuff trading at 10 times earnings, right? And then, of course, here in 2009 and 2008, during the financial crisis, look at this. Look how cheap everything was. The most expensive stock was 15 times earnings, and the least expensive stocks were like 7 times earnings. And so, everything was cheap, but it was a very tight band, right? It was a tight band of a lot of undervaluation. Everybody can see that, right? And through a lot of these periods, the bands are pretty tight, and the band's pretty tight. And then it starts to widen out right here. Look at this. And we start to get dispersion again between high value stocks, but there's still quite a bit of low value stocks or under less valued stocks, and quite a bit in the middle. So we're in another period of high dispersion as we were back in this period. All right. And where are we at on valuations? Just checking my time here. I think I'm doing all right. A lot on this page as usual. Well, this is returns. This is year-to-date returns. And you can see they've been really, really strong, with the exception of small growth companies have lost money this year. Small growth companies have lost money this year. That's in contrast to small value companies, which are up 23.3%, roughly in line with the S&P 500. And if you think back to a year ago, you may remember me warning everybody about the valuation of growth stocks at that time. And I noted the relative undervaluation of value stocks at that time. And indeed, at least in the small cap sphere of things, at least with regard to small companies, that has played out this year. As you can see, small value companies have way outperformed small growth companies. And that's good for new capital portfolios, because you have a healthy amount here, and we give you a little bit of this, but we don't give you as much for this reason. They're not expected to return as much. Also, in the mid-cap company size, you see that 23.8, roughly, again in line. This 23 point something is the theme of the day's returns year to date. Not bad for medium-sized growth companies. Not bad at all, 8.5%, but it's a big spread, 15%. between those. And that also is good for new capital portfolios because we give you more of this than we do of this. We give you some of this. Yes, we do, but we give you more of these. And this year, that's been good for your portfolio. In the large companies, though, look, take a look. Value companies that are large done very, very well, 21.3. But the blend companies, that is in between value and growth companies, and the growth companies have still had a strong year and still even marginally stronger than the large cap value companies. In other words, they've held their own despite the fact that these other smaller growth companies haven't done nearly as well. And even here in the mid-sized growth companies, the large companies. So large companies this year, it doesn't matter if they're value, it doesn't matter if they're blend, and it doesn't matter if they're growth. If it's big this year, it did well. Whereas in the smaller area, the value companies by far, and to a lesser extent, the blend companies. Okay. Now, over a longer period of time, you see the number, this is 10 years, the numbers, the numbers come together. Value 13, 13 and 12, 16, 15 and 13. And you see that the past 10 years has been a better period for growth companies. But where are the valuations now? Well, growth companies are now trading at 30.3 times earnings for big companies, 33 times earnings for medium companies, 42.8% for small growth companies. And that may have something to do with why these companies have started to fall off the pace because of that high valuation. And this is their 20-year average. So they're trading above their 20-year valuation in comparison, right? Versus if we take a look here, look at small value, 15.4 times earnings versus a 17 20-year average. That's actually right here, 90.4. It's trading at only 90% of its 10-year average, whereas everything else here is trading at over 100% of its 20-year average, and in some cases, very substantially so. Large cap growth companies are trading at 163% of their 20-year average. And then this is since the market peak. February of 2020 was when the market peaked, right before it fell off. And you can see what the returns have been. The best performing area has been 57.3 to the large cap growth companies, the Microsofts and the Amazons and Apples, although I don't know if Apple's actually considered to be as much growth stock now. And then everything else is in between. Their value stocks have not done as well since the market peak, February 2020. But look, since the market low, March of 2020, numbers are much closer together. And you can see that the biggest number there is the small cap value stocks. So a lot of these things trade places over time, and that's what's occurred. Okay, that's a look at valuations and returns. Moving along here. This is a chart of returns, and every year, as I've talked about before, there's a negative period. Ignore the lightning bolt. All these negative, another lightning bolt, all these negative numbers here. I got to get a new pen. Must be this thing. All those numbers are the negative, the maximum or the minimum negative numbers reached by the S&P 500 in any given year. And this year, we reached a point where we were only down 5% versus last year during the pandemic. In March, we were down 34%. So this year, the lowest we reached in the market, 5%, and where we are is a 23% positive gain. Again, I always like to show this chart so that everybody realizes that there's not really any year where there isn't going to be some negative period. You have to expect it, must expect it, and must accept it if you're going to be a stock market investor. I'm only going to show one chart today on international and international stocks, in which you can see is basically what this is showing is that we have reached a period that we haven't seen in the last 20 years of low valuation of international stocks versus US stocks. 2 standard deviations we have reached in the valuation of international stocks versus US stocks. And it's been a steadily decreasing picture since 2009. And so this is why we continue to invest you internationally, because this is going to turn around at some point. At some point, the really cheap 30% discount that you're getting to own a corporation that makes good products and has great management and customers and so on, people are going to wake up and say, okay, it's a 30% discount versus what is a fairly expensive, US market, 14 times earnings versus 20 times earnings. And so we are committed to making sure that we help hedge this problem of more expensive US stocks. We help your portfolio hedge that problem, not only by including less expensive US stocks, but also by including really substantially less expensive international stocks, and not just less expensive, sort of really majorly less expensive. I mean, look at this. We haven't seen this period hit, or that we haven't seen that low level of international versus US valuation hit in decades. So please don't ask me to sell your international stocks. I'm going to try to talk you out of it. If you order me to do it, I'll do it. I don't think it's in your interests. All right. Oh man, running a little bit long here. Inflation. Let me go quick on inflation, because we got to make sure we get to JC's stuff, and we will. Inflation. Everybody can see that it has ticked up right here, right? Gone along, very, very low inflation, and it has moved up. Nobody needs to be told that. A lot of the contribution has come from, energy prices and food prices, and we're getting a 6.9% reading in CPI. Totally something that we haven't seen for a long, long time. But as I say, there is also growth in the economy. It's not the case that we have growth in inflation, but not growth in the economy. That would be a really, really, really big problem. We are getting growth in the economy, and we're getting growth in inflation, but we're getting more growth in the economy than we are inflation. And so we all just have to sort of be a little patient here while these supply chains work themselves out. I'm not going to go through these slides because I'm running short on time. But this basically talks about how Jerome Powell, the Federal Reserve Chairman, decided, you may have seen, I think it was yesterday, to go ahead and begin to taper the Federal Reserve's intervention that began in 2008. And what they are seeing is several things that cause them to believe that they need to go ahead and act to put the stop on inflation. And let's see, maybe the one thing that I wanted to point out here in what they're seeing is a wage price spiral, right? So employers pay more in wages and other costs to keep their workers. The possibility that they simply pass on those costs to customers in a self-reinforcing cycle of higher pay and higher prices has become more real. This is a so-called wage price spiral, a feature of sustained high inflation that lasted from the late 60s to the early 1980s. This is Neil Irwin writing in the New York Times. And so this is what the Fed has their eye on. Not even so much supply chain issues, raw material supply issues. They are looking at this particular issue right here. Okay. Now, I'm not going to talk about Fed funds expectation. And let me just point out here that this is what the break-even rate is on inflation, the difference between inflation-protected bonds and regular 10-year bonds. And I just want to point out here that, I don't think there's a reason to panic over inflation. The market itself sees inflation that's still around 2.5% or so going forward. This is the market expectation, if you will, being seen in the bond market. And so this is a very, very important chart that we would look at to see what's the consensus view of the market. And even though we're seeing 6 and 7% inflation right now in the bond market, which is a very, very big market and a very, very important market, the bond market still is not seeing expectations for 6 and 7% inflation off into the future. So that's another piece of kind of good news for people to focus on. I'm not going to talk about this because we're short on time. It's basically just showing that purchasing managers are also seeing a rise in prices. That shouldn't be a surprise to people, raw material purchasers, and they're also seeing a rise in delivery times. And so the things that we're hearing about are actually borne out in the data, not just flim flam. Here is the Treasury curve. Only one thing I want to point out here, which is that this is where we are right now, December 14th of 2021, and the expectation is, now that we're hearing that the Fed is going to raise rates, more short-term rates. This is the short-term side of the curve, that it's going to we're going to see a rise closer to 1% or so in the short-term market. We're not seeing, as you see, a corresponding rise in long-term rates. We're still seeing that here, a fairly low long-term rate. It has risen from the purple, which would have been August of 2020. Definitely the curve has shifted up. Everybody can see that. Rates are higher than they were in August of 2020 when they hit bottom. But if the Fed raises these short-term rates, what does it mean if we have a short-term rate that's the same level as a 30-year rate? What would you do? You would say, I don't want to own the 30. I just want to own these short-term rates. And it is the possibility that you could see the curve invert, higher short-term rates than long-term rates. We'd get an inverted yield curve, and sometimes that may imply that we're going to get a recession. So we're watching the yield curve also. Let me clear the drawings. And JC is, I'm going to turn it over to JC, and she's going to talk about some planning issues, and I'm going to stay on the line too. JC, I'm going to work the slide movements. Is that right?
Yep. Yes,
Okay.
please.
All right, here we go. So, all right.
Hello, everyone. Good afternoon. Before we jump into the year-end tax strategies, I just wanted to touch base on the current tax proposals in the Build Back Better Act. There are some things, it's probably not going to be passed in 2021. It probably will push over into next year. But some things that we likely will not see, and Leonard, if you can pop through there, thank you. Things that we likely will not see in the final bill are that increase in the top marginal tax rate. It looks like that is going to remain at 37% versus the 39.6% that they were proposing. Again, no increase in the top capital gains tax rate. So that is also going to remain 20% versus the 25% that they were also proposing. And next, there is no reduction in the estate exemption tax. I know this was a big one, but it does not look like that is going to go through next year. That's going to increase to a little over 12 million per person. So 24 million for a couple. So that is not going through. Some things that are likely going to end up in the final bill are the child tax credit continuation through 2021. That is a permanent and fully refundable credit there. That's about $300 a month to people with children ages 0 to 6, and I believe $250 is it 6 to 17. So that is going to continue through 2022 likely. There is the elimination of backdoor Roth IRAs starting January 1. If it goes through, it may be retroactive to January 1. It just depends. But what this means is non-deductible IRA contributions are no longer eligible for Roth conversion. So if you're planning to do a non-deductible contribution and then go ahead and convert that to Roth IRA, that is not an option anymore starting in 2022.
If they pass it,
if they pass it, of course.
Not pass. Yeah. Just want to make sure everybody understands. This is what we're
yet,
trying. This has not been done. We're trying to. This is a particularly, given the conflicts that are going on in the Congress. These are proposals that are in the House Ways and Means Committee, and these have not been passed, but they may be. And so what JC's talking about here, I just want to emphasize, is that these are things that are, as the slide says at the top, likely right now, but not certainties.
Mm-hmm. Correct. Yep. And then likely you will be able to roll over unused flexible spending account funds. Usually those are use it or lose it in the same year. It will be based on each employer. I would assume they would likely also give that to their employees, but that is another thing that they're hoping to push through in this plan, to roll over those FSA accounts. Okay, So on to some year-end planning strategies. The first we are going to talk about are the charitable giving. Leonard mentioned this earlier. We want to make sure that if your charitable account looks a little low and you want to go ahead and make those contributions for this year, let us know and we can assist with that. One thing to consider if you are in a higher income tax bracket this year, we can look at bunching. So what that does is you'll take, X number of years contributions and lump it all in one year so that way you get a higher tax deduction. They made it harder with the high standard deduction the past couple of years to itemize and reach that tax deduction level. So this is an option if you wanted to do get a tax deduction, you bunch it all in one year, and then you can.
Yeah, and let me, sorry, JC, sorry to interrupt. I'm going to do this, and let me talk about why I'm going to do this. We got a high stock market, right? I own stocks. I own stocks that are appreciated, and if I sell them, there would be a tax on them. So Hannah and I have a charitable account at Fidelity, as many of you do. Not most, a lot of you do, and we're charitable. We're both still working, and so we have income, and we're taxed in a higher income tax bracket because we're still working, and we're in the prime of our careers, and so we itemize our taxes, our tax deductions. We don't take the standard deduction. So this is a good year for us to take some of that highly appreciated stocks, and we'll give them to our Fidelity account. There'll be no capital gains tax on the contribution, and we'll get the full whatever we give into the account as a deduction. And now we have reloaded our account for maybe several years to come of charitable contributions. So that's this idea of charitable giving and bunching. And if what I described to you thinks that works for you, then let us know, and we can discuss it with you or facilitate it or whatever you want to do. Okay.
Right. All right. Thank you. Next on Roth conversions. So Roth conversions are typically something that we would do in a year that you are in a low income tax bracket. What this does is accelerate that income into that year when you're in the lower tax bracket, so you can go ahead and pay the tax that you would on the IRA now versus later, and then you have those funds to grow tax-free and tax deferred in that Roth IRA. Again, if you're interested in this, let us know. We have some tools we can use to run those simulations and see if you would benefit from a Roth conversion.
And yeah, generally, if you have low income, right, you would benefit from the Roth conversion. If you're already paying a high tax rate, it doesn't tend to make nearly as much sense, because you pay to convert, you pay the tax on the conversion at that higher tax rate. But if you're in a really, really low tax bracket right now, then you may want to take a look at it. We can do that.
And then just a reminder on annual gifting, the limit is still 15,000, or the exclusion is still 15,000 per person. So if you're planning to make any gifts to, children, family members, friends, you have until the end of the year to use that $15,000 exclusion per person. So just a reminder there, if you're looking to do that, and if we can help facilitate any of that, let us know as well.
Okay.
And then next, Leonard and I will touch on this, the I-bonds. Leonard, I don't know if you wanted to take that one, but.
So people know that we've been buying inflation protected treasury bonds through mutual funds for you for quite a bit now, couple years in meaningful amounts. And I still think they're a good idea. And so you can also gain this type of exposure through what's called an I bond. It is a treasury inflation protected bond, but it's issued directly by the Treasury in limited amounts. And you can only buy as an individual a certain amount each year, and that amount is $10,000. 10. That's it. You can buy $10,000. So if you got $5 million account, you'd say, well, you know, that doesn't scratch the surface. But what you might do, and this is something that I'm probably going to do, is I have 4 members in my family, a wife and 2 children, and I could buy $40,000 worth of I bonds this year, and I could buy another $40,000 worth of I bonds next year. So, you know, on December 31st, I'm not saying I'm going to wait that long if I do this, I could buy $40,000 of I bonds. And on January the 3rd, I could buy another that's $80,000 in I bonds. You know, that's pretty meaningful. Now, the bonds are selling with a certain interest rate that is fixed until around March, the current version of the I bond, and it's based on the current level of inflation. So the yield on the I bond is 7.1%. I'll say that again, 7.1% is the yield on the I bond. It is a long bond, it's a 30-year bond, so, but that's a long way from the 1.8% you're getting on the regular 30-year Treasury bond. You can only buy $10,000 of it, and you can only buy it in treasurydirect.gov. We cannot buy it for you at Fidelity. You can't buy it at any brokerage. And also, you unfortunately cannot put it into your IRA, where that would be great, because then the coupon interest that you get wouldn't be taxed. So you have to buy it at treasurydirect.gov. Now, I opened for myself an account. I haven't funded it yet, and I haven't bought the bond. And we are planning to sort of do this for clients if we can, but we can't get it done before the end of the year, because to open the account, it's government website software, really not so friendly to use. It's going to send your phone a thing, and it's going to send your email a confirmation thing, and we're not going to get it. And so if you want to do this, we're asking you to go, if you want to do this here in 2021, this year, we're asking you to go to treasurydirect.gov, open the account. You can link your regular checking account. You can also link an account from Fidelity, as long as it's not an IRA, you know, a regular joint or individual account, and they'll move money over and you can buy your $10,000. Now, if I have 4 family members, I'll have to open 4 different accounts at treasurydirect.gov, one for me, my wife, son, and daughter, to get this done. So it's sort of labor intensive, and you may say, God, you know, forget it. It's just not worth the messing with. But we want you to know that it's sort of one of the better year-end deals around right now because of the high inflation rate. It'll, you know, if you sort of work it, you can get a holding in it over the next year or so that's, you know, maybe meaningful. So there's that. Let us know if there's any questions. We'll have time for chat questions in just a second, but that's I bonds. Okay, what's next? Oh, that's it.
Okay.
Was there anything else, JC?
Yeah, I don't know where it went, but
Okay.
we're going to talk about the state and local taxes.
Oh, okay.
There is the possibility to lump those also into a single year. So if you owe property taxes, there may be an increase to that cap. Right now, it's $10,000 is the limit of deduction you can take on property taxes. So next year, they may increase it. If you're able to push property taxes into January and pay for 2021 and 2022 in the same year, there is the possibility to lump those together and get that higher deduction. If you're in a higher tax bracket again next year, that would be something that we could look at doing for a bigger tax deduction as well.
All right. And the idea there is that there's talk among a Democratic-controlled Congress that they're going to do away with the caps that were put on state and local taxes, which is what SALT stands for, that was put in under the Trump administration. You may remember you used to be able to deduct your full mortgage and full property tax, and that's no longer the case. But the Democratic-led Congress, states that are Democratic states are states like California, New York, Massachusetts, places where they have high local property taxes, and those constituents are pushing their representatives to get rid of that cap. And so we may see that happen in the Build Back Better bill. And those of us who own homes or have mortgages here in Texas that are on the higher end of the spectrum of mortgages and taxes would benefit from that also. Okay, so let's take some questions. We're only 2 minutes over 1 o'clock, and we'll open up the chat if there are any questions. And Catherine, we're ready for that. And
Yeah, so
go
we
ahead
had
and shoot.
Yeah, if anyone, we've got one question that came in during the presentation. So if anyone else has questions, or if you've thought of anything else that you would like to ask, go ahead and type it into the Q&A tool and we'll get started on this first question. It came in a lot earlier in the presentation, but we saved it till the end. So it says, do you have any prediction on the Dow future market when our political future is so dysfunctional due to post-Trump conspiracy and voter suppression?
I think the short answer is no. I'm never able to predict and never try to predict the market. I would simply reiterate again the point I've made on a number of times, that there is a very high correlation between the market values of countries that are sound democracies and their market values. So places where democracies are more sound have higher market valuations. And so if we saw some erosion in this country, and there are articles now that are talking about, there was one in the New York Times yesterday or the day before, a piece by Thomas Edsall, who I read religiously, Edsall. The great thing about Tom Edsall is that he's really not giving his opinion. He is a person who surveys and canvasses political science and sociology academics and reads their papers and then gives a summary of them in his column. And there are academics who worry that the structural issues in the U.S., really the Constitution and the compromises that were made early on to create this country. I mean, it's no secret. Everybody knows that there were some compromises that had to be made way back in Philadelphia, you know, you know, what, 1783 or so? Let's forget my Constitution year. Whenever the Constitutional Congress met, I think it was 1783, or was it 89? Anyway, I'm embarrassed to say I get that date wrong. But there were some compromises made to create this country. To get small states to sign on, they had to get 2 senators, and to get slave states at the time to sign on, they had to get their goodies. And everybody got their goodies back then. And what we're now finding is that those goodies are sort of haunting us a little bit here. Not a little bit, quite a bit, right? The goodies are haunting us. And we can't quite get untangled from that. And that's causing people who want to hold power and have a strong desire to hold power at all costs to use the loopholes that exist in our Constitution that arose from these compromises that had to be made, to use those loopholes, you know. And now what we're hearing about now, sort of in the past few days, is an attempt by the sitting president at the time and people working for him to sort of use loopholes. You know, oh, well, we're going to throw out the electoral votes, and if we just do this, then the state legislature can cast the electoral votes. And if you really, really want to stay in power, and I'm not saying I agree with their politics or disagree with their politics, that's not my point. My point is that if you're a side that believes your side is right, and you think that loophole can be used, you may be using that loophole. And so if the country continues to push through in those loopholes, and we don't sort of solve the structural issues that arise continually and now from those compromises that were made to establish the country's constitution, that could cause problems, and that conceivably could cause problems in the valuation of our markets. I think that is a possibility, and another reason why, we have you invested internationally. Okay, so it's a long answer, and the short answer is I don't know, but it's possible.
Okay, we had another question come in. It says, was there interest in the Swiss bank option? I guess from
Yeah,
the
that sort of
conference.
flows from the last question, and the answer is I'm still working on it. I'm just trying to get the pricing right. They've been very tough. This the Vontobel Bank has been a little tough to push on price in a negotiation, and I've done my best. I'm about to just say, okay, that's as much as I can do. There's not lots of Swiss banks that are an option. So I think we're pretty close on that, where we'll be able to offer clients the ability to open an account there and put some of your money there. And I would be the first person to do that. And if we can come to this agreement, which I think we will, I'll be the first person to open that account. Just to make sure that I have a way to hedge jurisdictional risk here in the United States. Doesn't mean I think that it's going to be needed. It doesn't mean I think that anything's going to come to pass. It just means we want to make sure that that we diversify you in that way as well. Other questions? That's it?
Nothing else has come in yet.
Oh my
So
gosh.
we have a few more seconds of
Oh my-
opportunity.
come on.
Before we do that, I'll jump in for a moment until we get something else. And just as a reminder, we are doing NCM 360 access sessions. I've sent out, you're getting notifications in the journal, but just another reminder that if you have not scheduled a meeting with me to get access to our data system, NCM 360, you can do that. We're taking, it's a video call. It's probably anywhere from 15 to 30 minutes, depending on your questions. So if you would like to register for one of those sessions, you can go to our website. It's newcapitalmgmt.com/NCM360. And from there, you'll get a calendar and are able to schedule at your convenience. And no other questions have come in.
I don't know if that's good or not good.
I think you answered all possible.
I'm gonna choose to take the better side. I want to thank Catherine also. We have gotten a lot of good response. As most of you know, we sent you a different season's greetings gift this year of coffee and chocolate, and we had a lot of people who liked I'm a cookie guy, so I like cookies. But Catherine found this wonderful coffee and chocolate, and I want to thank you, Catherine, for doing that, because we've gotten a really good response. So thank you for making people happy in that way. My wife got ours, and she hid it.
That's a good sign.
She hid it away. She hid it away from me, I think.
I think on the cookies you tried to share it, so you weren't the only one.
Yeah, I
eating.
haven't been able to find. I haven't been able to find that coffee. It disappeared. So anyway, I think there's another question.
Yes, one did come in. It says, how did Bitcoin do by the end of the year?
Bitcoin. Let's see what Bitcoin has done. I think it's up this year for sure. It's been weak lately. I think it's lost about 20%. It's very volatile, lost about 20%. Year to date, where is that? Oh. I'll have to get back. It's up very strongly this year. It's had some ups and downs. Bitcoin's roughly doubled this year. So it's been a very, very strong period for Bitcoin. We've had clients ask about Bitcoin, and I've asked clients about Bitcoin. Every time I ask, people are like, I don't know. We're not able to buy you Bitcoin through Fidelity. It's sort of the same problem as the 10-year I bond that we were just talking about. There are funds that have been coming out. There have been some recently approved funds, but they're not actual what are called spot funds. They are futures funds, and that's very, very different. And the value of those funds can come unglued sometimes very dramatically from the underlying value of the asset. And the SEC has still not approved a pure Bitcoin fund. And so the options are, there's a private fund put out by Fidelity, which has a $100,000 minimum and some pretty good hefty fees, or you can open a Coinbase account yourself, sort of the same way with the Treasury bond, the iBond account. You can do that as well. And you can buy Bitcoin or Ethereum or whatever you want there. It's very hard to know right now how much of the pricing of those cryptocurrencies is bound up with the overall high prices that I have described to you early in my presentation today. But I would think that there's at least some meaningful amount that if we got some large sell-off of growth stocks, sell-off in the stock market, we might see the same in Bitcoin as well, perhaps even more given its volatility.
Okay, we actually do have some more questions coming in. One, to clarify, to clarify, the iBond interest rate is adjusted each year based on the CPI inflation rate?
Yes.
Question?
I actually don't know that it's annually. It may be biannually, actually. I think it may be twice a year.
Yes, every 6 months.
Okay, so is that biannually? Did I say that right?
Yes.
Okay.
Yes.
So it's a biannual adjustment. Every 6 months, it is adjusted. And so since inflation readings on CPI came out so big back in, now, November, the government has to set the iBond equal to that inflation rate. So you can buy an iBond with a 7% yield and, pretty good. So I know that our questioner has 2 people in their household. And so you guys could buy $40,000 worth of 7% bonds, 20,000 this year, and then another 20,000 after the new year. It's pretty good. $40,000 of a 7% bond is nothing to sneeze at. Now it is a 30-year bond, so it's a long bond, but that's, you're getting over 5% over the standard 30-year Treasury bond. And this is the reason why they limit this iBond to $10,000 per person. So there it is. That's that iBond. And again, we're happy to answer any questions or help you if you get going and you do decide that you open this account at treasury.gov, you need some help or something's not clear, please ask us. We'll help you. I'm going through the process myself.
Oh, and I will jump in also, JC, I don't know if you mentioned this yet. I'm going to be following up today with an evaluation survey, and we added a question on there. So if one of the year-end planning techniques that JC discussed is of interest to you, we've added a question for you to indicate that there. So also feel free to email us or call us if you think something may be applicable to you, but that form is also on the evaluation. Another comment that came in through chat, it said, could you spend a bit of time explaining non-fungible tokens, NFTs?
Well, I know enough to be dangerous on an NFT. So I guess I'll go ahead and get dangerous. The NFT is built on the blockchain concept, and that basically means that it works on the blockchain ledger. And it is, and just as the blockchain ledger is used to prove up the validity, the provenance of the Bitcoin currency or the Ethereum currency, cryptocurrency, the blockchain is being looked at and employed and developed and used to prove up the validity and the provenance of other things as well, including real estate contracts. So think about DocuSign, right? Right now, everybody's getting, and we send out from Fidelity things like DocuSign. So think about if there was a contract that could be passed in the same way that currency under Bitcoin is passed, and you could pass this legal real estate contract from party to party, and you knew that this contract, whether it was real estate or a purchase order from a company, it was a way to prove up the validity and the provenance. Well, that has a very, very enormous, wide variety of uses. And so the NFT has caught on in the art world of all places, right? The art world, where proving up the original provenance of a painting or a sculpture, any work of art. This is the original one, or a movie, or a piece of music, anything. That this has implications out of the blockchain. And so the non-fungible token is a way to attach a blockchain type validator to a work of art. And that is happening in the digital art world, where somebody makes some digital piece of work and the NFT is attached to it. And then that NFT basically serves as a way to validate that this was the first one of these, right? Because if you could copy a digital file and send out a bazillion copies of it, who had the first one? Which one was the original? We don't know. It's just a bazillion copies out there. And so this is a way to you get my point. This is a way to assure the validity of originals and additional serializations of works of art, and that's where it's being used in the art world, these NFTs. Now, I was lucky enough to have dinner with a good friend on Friday night who is an artist, one of the best known artists in Houston. Excuse me. And he was talking about NFTs and that there are different kinds of NFTs. So he said he doesn't like the kind of NFTs where it does what I just said. It's basically validates this original copy. He informed me, and I learned on Friday night, that there are new kinds of NFTs developing where the original copy, the NFT that makes the algorithm for the NFT, will change the work of art slightly. Will change it slightly so that now the second piece made with the NFT is a little bit different, right? So it's like if Van Gogh made a series of sunflowers, right? The first one is the sunflower, and then he made a second one that's a little bit different, and a third one's a little bit. So there are NFTs that are coming out now that take the original digital work and change it up a little bit, and maybe this color is different, and so you now have an original second copy automatically made by the NFT, and that can be proven to be the only existing second copy of that kind. So those are the sorts of things that are going on in the world of art and NFTs. How do you invest in it? I couldn't tell you. But I'm sure it's coming at some point. But it's a very, very early area right now, and there's been a lot of focus on it in the world of art because it may solve some issues in the art world where fraud is quite a problem. Fraud is a very major problem in the world of art, and so maybe this will have some benefits there. There are quite a lot of articles that you see regularly about art fraud and art theft and all sorts of other problems that go along with those sorts of assets. Okay, any other questions?
Yes, we had another one come in. Can the $10,000 inflation risk-free bond be sold?
I can't imagine why not. I would assume absolutely.
It's liquid after 1 year, but if it's sold within the first 5 years, there is a penalty.
All right, so there it is. What's the penalty, JC? Does it say?
You forfeit the previous 3 months of interest.
Interest. Okay, so if you sell it within, as JC just said, if you sell it within the first 5 years, you forfeit the latest 3 months of interest. Not too bad. And you cannot sell it at all within the first year. Okay.
Okay.
Now, I would imagine if you went out and tried to buy I-bonds from another person, they're not going to give you the $100 price on it. Okay. My guess is that they're going to say it's worth $107, right? It's going to include the higher value with the current inflation price. So that's a really good question. But my guess is anyone trying to sell their I-bond right now isn't going to sell it to you cheap. Anything else, anybody?
Looks like one person asked a question and said, who is your current guru for financial advice?
I am. What do you mean? My current guru for financial advice. We have one guru in this office, and frankly, he's the guru, I would say, for our entire industry. And I've said his name many times. His name is Michael Kitces, Kitces. He is the guru. He's too much guru. He puts out like 50 things a week and makes me feel really small and lazy that I can't get to, a quarter of it all. I met him once. He spoke at a CFA meeting at Rice University, and he's terrific. He publicly says this. He has, I think it's Asperger's, maybe. He is and all he thinks of is financial planning. That's it. So this is an Asperger's guy who found his thing, and he knows just about everything. And if he doesn't, he finds out and he writes about it. He has a whole staff now that helps. And we are enormously, as an industry and as an office, indebted to the work of Michael Kitces, who is a great, enormous guru. I don't think there's any question about that. I think if you were to ask any, at least independent financial advisory office, who's the guru, Michael Kitces' name would come up. JC, you think so, Catherine?
100%.
100%. Yeah, it's a good question. And you can read his stuff too. And if you can, you should. He's got a few websites, kitces.com. I think one's for advisors, but he may have a public facing site now, just for regular people. But beware. If you're, you'll have some night table reading, every night. There's that much stuff. And it amazes me. I often think, well, what more can he come up with? And yet he just keeps coming up with more and more and more. It's amazing. Mm-hmm. Anything else, anybody, before we let you go and get on with your day?
No other questions.
Going once. Going twice. Sold. Thank you all. It's been great to be with you. We will not, this is our last, event of the year, but we, of course, will have more in 2022. So we want to take this opportunity while we're here to wish you very, very happy holidays, whatever holiday it is that you celebrate, and a very, very happy new year, and a healthy, of course, a healthy end of 2021 and a healthy 2022. And as always, we want to thank you from the bottom of our hearts for your trust and your kindness, and for being our clients. It really gives tremendous amount of meaning to all of our lives. So thank you for all of those things. Be well.
Thanks, everyone.
Bye, everyone.